Welcome to the presentation for the Midwest Multifamily Fund, sponsored by Gray Capital. Gray Capital is a vertically integrated owner-operator of multifamily apartments headquartered in Indianapolis. We've been in operations for well over 10 years and a track record of no capital losses and zero unplanned capital calls. One of the reasons why Gray Capital is so well positioned to take advantage of the opportunities that are presenting themselves in the current market. I'm going to tell you just a little bit about Gray Capital before we get into the fund, including that our co-investments are well above the industry average, as low as 10%, but can be as high as 20% into all of our projects that we pursue here at Gray Capital. We feature monthly distributions and industry-leading reporting as well as investor servicing. As an LP myself in well over a dozen commercial real estate private placement investments, I understand good reporting, timely K1 delivery, and the differentiation that premium investor servicing can make, especially dealing with high net worth investors, institutions, and family offices. Our track record speaks for itself. We've had well over 10 full cycle exits with an average total IRR of just under 30%. But typically we're long-term holders with many of our best projects still under operation and being self-managed by Gray Residential, our in-house property management company. So what I want to talk about today is the opportunity, the thesis, and the vehicle that we've created to take advantage of it. I want to talk about why the Midwest, why this region has been overlooked for so long, passed by coastal buyers and institutions, and why and how that is changing. I want to talk about why in this moment, as we are sitting in 2025, we are preparing to deploy capital in the middle of 2026, where we believe will be a prime opportunity to acquire high quality, stabilized, cash flowing multifamily properties at a steep discount to their peak, below the cost of replacement, and in a period of market strength and growth as supply is receding precipitously every single month. I also want to talk about the fund structure and the terms, how we've created a very simple, straightforward, and transparent fee and waterfall structure that every institution and investor can easily understand, aligns interests, and doesn't overcomplicate the process or reporting. I want to talk about which markets in particular that we're the most excited about and how we'll be acquiring and getting the deal volume in order to fully deploy the fund. Gray Capital has one of the best deal pipelines in the industry in the Midwest, with a deep network of owner-operators, developers, and brokers throughout the region. Finally, why Gray Capital? How are we positioned to take advantage of this opportunity? And then lastly, how to get started and take the next steps to participate in the Midwest Multifamily Fund. Right now, there's a window of opportunity emerging. There's a sharp decline in new apartment constructions, with starts in many markets down well over 50% year over year, after a peak supply wave of the highest rate of new supply in almost 40 years in the multifamily industry. And then a persistent housing shortage of up to 7 million housing units. Even though we have been delivering so many new housing units in the form of apartments and single-family homes, we are not catching up as the population continues to grow. And the demand for apartments has never been as high as it is today. And that fact is not changing anytime soon. So the thesis behind the fund: we're going to target 7 to 10 stabilized, cash-flowing multifamily properties in growing markets in the Midwest. We're going to acquire these assets from distressed or over-leveraged owners at attractive valuations. These properties will be acquired well below replacement costs and again, fundamentally strong in supply-constrained markets. There's an opportunity to not time the market, but take advantage of clear trends, whether that is in a wave of loan maturities that will be peaking near the end of 2025 throughout 2026, or those factors of extreme supply reduction, creating positive headwinds for further rent growth throughout the hold period. What's behind it? Gray Capital, we are targeting some of the most resilient and demand-driven multifamily markets in the United States. The Midwest fundamentals are set up for a solid multi-decade cycle of growth as the reemergence and the renaissance of manufacturing in the United States takes hold, as we are building new battery plants, power facilities, data centers, in advanced manufacturing. The Midwest with low cost of labor, relative affordability, and the workforce that is trained for decades is the prime region to take advantage of this opportunity. And it's not theoretical. It's been happening for the last 5 to 6 years, and we are still in the very few first innings of this shift to the Midwest and seeing great growth opportunities. So much attention has been paid to the Sun Belt or the primary and gateway markets where there is more than ample liquidity. The Midwest has been overlooked, and we're going to take advantage of that huge inefficiency in the market. By acquiring stabilized, market rate institutional size assets during a period of dislocation sets us up for a huge advantage as Midwest regions become more institutionalized and those large buyers begin to shift to the Midwest. Rent growth over the next cycle is forecasted to be well above the last cycle average, as inflation is higher than that period of time and supply is falling off a cliff similar to levels that we saw during the Great Financial Crisis. We're targeting 20 to 60% value discounts from peak market valuations, giving us ample headroom of our capital stack. Our disciplined underwriting process, paired with in-house property management that is tech-forward, AI-enabled, and also focused on in-person customer service, allows us to further drive value to renters, allowing us to push rents even further beyond just physical improvements. We have a preference for long-term fixed-rate financing. That's one of the reasons why Gray Capital is not facing any stress throughout our portfolio. Again, we underwrite diligently, accurately. I like to say conservatively, but everyone says conservatively. I think we underwrite accurately. And the fact that we have never had to issue a capital call is a testament to that fact. Let's talk about the fund. It's an opportunistic $200 million equity fund targeting around $500 million of stabilized multifamily assets. We're focusing on existing income-producing assets and in high-growth Midwestern markets like Indianapolis, Columbus, Ohio, Fort Wayne, Indiana, and other even smaller markets such as South Bend and West Lafayette, Indiana. The fund is designed to deliver consistent cash flow over the hold period, as well as opportunities for large value creation at sale and exit. Have a simple and transparent fee structure with a asset management fee starting at 1%, but it can tier down based on allocation size to as low as just 0.25% of deployed capital. The fund features an 8% preferred return and a single tier 85-15 LP-GP split. A split so investor friendly, it's almost unheard of in the industry. One of the reasons why this split is so favorable to investors is it's a win-win for Gray Capital. One, we are making a large capital investment into the fund itself. Approximately 10% or $15 million of our own capital, net of fees, will be going into the fund itself, and that number may increase as time goes on. But that 85-15 split allows for maximizing investor returns and allowing Gray Capital to expand our footprint into markets where we already have presence, but also new markets such as Columbus, Ohio, where we expect to build a large footprint as that market continues to institutionalize. It's a win-win for Gray Capital in our vertically integrated family of companies, but it's also a win for yourself, the investor, or if you're a registered investment advisor or an institution, it's a great fit for your clients as well to allocate to stabilize assets in a stable market, but with a fee and promote structure that aligns interests and maximize returns. You also can be rest assured that you're partnering with a partner with over a decade of experience and an experience through multiple cycles and have navigated successfully multiple challenges and headwinds recently and over the last decade. And as I mentioned, we have a centralized, tech-driven, vertically integrated management platform that has proven to outpace the competition and deliver returns. We are experiencing in our portfolio still robust rent growth, even when national rent growth is flat or negative. Again, the objectives of the fund: deploy capital into 7 to 10 high-quality, carefully curated multifamily assets in growing Midwestern markets. Deliver reliable, tax-sheltered cash flow with an annual preferred return of 8%. Unlock value through strategic enhancements and operational efficiencies, targeting IRRs between 16 and 20% net of fees. Then preserve capital through diversification and proactive risk management across markets, vintages, and market profiles. Let's talk a little bit more about why the Midwest is such an attractive region right now. Again, the Midwest is home. Being based in Indianapolis, I was born and raised here in the Midwest. It's always been our home, and we always frankly thought maybe we have a little bit of home country bias. I've always liked to invest in my backyard, markets I know better than any other market. Now, it just so happened after the decade that we've been doing this business, the Midwest has really turned into the premier multifamily investment market, partially because it's been overlooked for so long. It's been our thesis for so long that we are taking advantage of inefficiencies in the market, taking advantage of slightly higher cap rates seen in the Midwest, but still pairing that with some of the best debt available through the agencies Fannie Mae, Freddie Mac, as well as HUD, fixing long-term debt, the interest rate, while we grow net operating income and buy attractive in-place yields. Just looking at the Midwest rent growth compared to the national average is more than double. Where other markets have seen negative rent growth the last several years, markets in the Midwest, such as Indianapolis, Columbus, and many others, have seen positive rent growth. We also didn't see job losses or significant rent declines during the pandemic. And even going back to the great financial crisis, Midwest markets were much less impacted compared to some more high volatility markets. That's really the theme of the Midwest: low volatility and stability with consistent growth. The really only difference in the last several years is that the amount of jobs and population that is growing in these Midwestern markets has surprised many market participants, and many have been slow to catch up. Much of this has to do with affordability and the existing labor force in these states that are trained through decades of practice for advanced manufacturing in a variety of industries. The Midwest is also an incredible transportation hub with some of the world's largest logistics facilities in Indianapolis and Louisville, as well as an incredible expansion of rail lines going through the Midwest. It's no surprise why auto manufacturing, data centers, as well as new battery plants, EV manufacturing facilities, and more are all focused around these Midwestern markets. And again, in vacancy, compared to the national average, is also much lower than it is compared to the Sun Belt. The Sun Belt has experienced an incredible amount of population growth and will continue to see that type of growth. The problem with investing in the Sun Belt is every other investor has the same investment thesis to deploy capital into those markets. And as we've seen, those markets are now incredibly oversupplied with negative rent growth and a huge miss on total returns. And so if you're looking for a stabilized region to invest in, the Sun Belt doesn't necessarily check that box. Higher potential return if you can time the market, but much higher risk level, where the Midwest offers similar or the same rates of return, but with much lower risk, providing a really nice sharp ratio, being able to get out on the efficient frontier, less correlation from public equities and bonds, providing great diversification to an overall portfolio, but giving the confidence that those markets are going to continue growing and being stable. And the upside for the fund, which we haven't factored into our underwriting, is the institutionalization of these markets. When the large institutional investors begin to pivot, and I think it's a when, not an if, those cap rates in those markets would be expected to decline and values increase, but this will be well after we deploy capital into the fund. Supply trends continue to favor Midwest markets. More supply will continue to go into the Sun Belt, and supply in the Midwest will be relatively balanced, allowing for above market rent growth over the hold period of the fund. Just looking at new inventory under construction in the Midwest, it's about 2% of the overall existing inventory compared to the nation at 3%. And again, looking at those vacancy numbers, that's where it all shows up. The Midwest average vacancy is around 6.9, where the nation is currently at 8% average vacancy. Some of the economic drivers, this transition is happening right before our eyes. with major employers expanding in our target markets. Examples are Eli Lilly's $13 billion project just outside of Indianapolis, or in Columbus, Ohio, Intel's $20 billion chip manufacturing foundry. Again, and that's just a small example of the billion-dollar projects that are ongoing right now, and that does not include the $1 billion and hundreds of millions of dollar projects that are being announced seemingly every week here in the Midwest. The data just aligns with this so much. Looking at this chart of momental growth in domestic manufacturing, you see a huge concentration in our target markets, which are essentially circled here on this image. It's incredible, the concentration in Indiana, Ohio, and Michigan, as well as Kentucky. And again, the institutions are slow to move into transition from overbought regions into a very much underbought Midwest. Again, looking at U.S. private sector manufacturing investment announcements, this is just from 2021 to 2024. You see those huge circles of volumes of millions of dollars concentrated in our target regions. While there is also plenty of announcements and jobs coming into the Sun Belt, honestly, the Midwest looks a little bit more concentrated and at similar levels. But the amount of housing inventory going into the Sun Belt is a multiple of the inventory going into the Midwest. And we are going to see continued demand for housing, and specifically rental housing in these Midwestern markets. When we look at manufacturing, who are already the leaders, will most likely continue to be the leaders of manufacturing jobs. And these manufacturing jobs are incredibly valuable employment opportunities. Indiana is the number one state in the country for total or for percentage of the workforce focused on manufacturing. And the rest, the second, fourth, and sixth, and seventh are all states that are targeted by the fund, with millions employed in manufacturing. What's exciting about that is when you create a durable manufacturing job, you're actually creating 7.4 new jobs in other industries. This is significantly more compared to retail, which creates only 1.2 new jobs for every retail job. This will be an absolute boon to Midwestern markets across the region. Looking at logistics, new investments in rail, cargo, air travel, as well as trucking, all favor the Midwest, with over 80% of the United States population being accessible from markets like Indianapolis. That's why Indianapolis, Louisville, and Columbus have all been logistics hubs. And now paired with this accelerated manufacturing, it is a great combination for accelerated employment growth, population growth, wage growth, and rent growth. Again, looking at just some of the first tier distribution hubs and rail terminals, this massive concentration in the Midwest, with first tier distribution hubs in markets such as Indianapolis, Chicago, Columbus, and second tier distribution hubs in markets like Cincinnati. Again, we are primed. E-commerce is not slowing down anytime soon, and the Midwest is the key to get these goods to the vast majority of the United States. But why now? These dynamics have been in play for several years now. Why are we raising capital to deploy a fund in 2026? Well, renting has never been the more ideal form of housing than it ever has been before. The cost of a mortgage is more than double the long-term average relative to the cost of renting an apartment. It's an extreme gap and has made home ownership even more unaffordable than it already was. Millennials that are entering their peak home buying years are putting off those purchases. And we never really anticipated until recently that we would have so many older millennials staying in apartments for longer, increasing the level of demand while we are still falling behind on supply. These home price and rent to income ratios, continue to fall and will continue to drive demand for apartments. As mentioned earlier, we've just gotten off a period of peak supply deliveries, which really peaked near the end of 2024 for most markets. Some markets are still going through their peak. But after that peak recedes, new supply drops to almost more than a decade low, driven by high interest rates, investor uncertainty, and it's too bad because we still need millions of new apartment homes in the United States, but frankly, the interest carry costs, the cost to build new apartments has gotten so high that rent levels today are not high enough to meet the cost to deliver new construction. And the equity just is not available to deliver new construction. And that likely will change in the near future as it's clear that rent growth will continue to rise as demand remains steady and supply continues to drop. But as it is right now, we are going to experience a multi-year period of decades low new supply in a period where the Midwest is already seeing strong rent growth. In some of our target regions, we're seeing rent growth as high as 5%, and that's with new supply coming online. As supply goes down to nearly zero, we anticipate rent growth to accelerate. The other factor that could lead to some incredible acquisition opportunities by buying assets at an extreme discount is the prospect of forced selling in early 2026 due to a wave of loan maturities. These were loans, primarily bridge loans that were taken out during 2022, typically 2-year, sometimes 3-year bridge loans that many of which have expired. The properties were underwater relative to the value of the debt. They had those loans extended. And at some point, a decision will have to be made whether those properties will need to be sold for a loss or if lenders will be able to continue to extend these short-term loans. It's the opinion of Gray Capital that not all loans will be extended and some forced selling will begin to take place near the end of 2025 and into 2026, kind of in the prime deployment window of the fund. Now, there is certainly a price floor on multifamily as the demand is high, but the volume of transactions has been relatively low. And as new inventory for for-sale multifamily comes online, we could see a slightly further price decline for multifamily acquisitions. Now, prices are down 20 to 30% from peak pricing, so we do not expect a huge further price reduction, but with billions of dollars of loans coming to maturity, something may give, and it could provide the fund with incredible acquisition opportunities. That's why we're getting ready right now to take advantage of the potential distress later on. Now, the fund doesn't require there to be widespread distress, and frankly, it's really not in our base case over the next several years, but there will be tactical opportunities to acquire properties from stressed sellers, especially in a period of uncertainty where Gray Capital, we have confidence in the long term, especially utilizing fixed rate financing, longer term hold periods, in-house property management, the ability to control expenses, while some other buyers are still on the sidelines. Let's talk a little bit about the fund, the structure, in the terms of the deal. As I said earlier, it's a relatively straightforward structure with an 85-15 LP-GP split and an 8% preferred return. The GP is going to be co-investing at least 10%, or around at least $15 million into the deal. We're raising anywhere between $150 and $200 million of equity. The plan is to raise the vast majority of capital before the fund is closed and we begin to deploy capital into multifamily assets. We're looking to buy about $500 million or $500 million of multifamily properties, again, spread over 7 to 10 assets, depending on each individual deal size. Now, no one deal is going to make up over 20% of the overall fund, and we'll be able to achieve that by utilizing sidecar investment vehicles that we'll offer to our fund investors if they'd like to over-allocate to a particular asset. We're going to be raising capital for about 9 months before we deploy. In the term of the fund is going to be between 5 and 7 years. Profit split, as I mentioned, is an 85-15 LP-GP split, and we're targeting net investor IRRs between 16 and 20%. We'll have a deployment period of 2 years, so starting next year, we'll give ourselves 24 months to deploy all of the capital. We think that's going to be a great period to be deploying equity into multifamily. As I mentioned, co-invest sidecars are allowed, allowing investors to over-allocate to one particular asset. There are no early redemptions, and there will be limited liquidity options through internal sales, and ask us more about that later. Let's talk about investment criteria, the types of deals the fund will be targeting. And if you're a current Gray Capital investor, this is going to look relatively familiar. Primary targets are Indianapolis and Columbus, Ohio, both capital cities in the respective states. But we're also going to be targeting the secondary markets across Indiana and Ohio, markets that are growing. So we would not be targeting a market such as Cleveland, but we would be going after a market such as, again, Columbus or Cincinnati in Ohio. But also secondary markets in Kentucky and Michigan as well, such as Grand Rapids, suburbs around Lansing, or Louisville or Bowling Green, Kentucky as well, all within our operational footprint here at Gray Capital. All the assets are going to be market rate multifamily, stabilized deals. We're buying Class B or better. Essentially, we're looking for either a newer property with need for some operational improvements or some slight physical improvements. We'll even buy up to a brand new property if there's enough cash flow there. And again, there's room for us to find some value add plan to move net operating income. We also might buy or could buy a mid-1980s vintage product with low physical obsolescence that we can improve physically to be able to compete with newer construction by adding amenities, improving interior features. You see a picture here on the top right of the screen of Club Meridian. It's one of our properties outside of Lansing, Michigan. In Okemos, Michigan. It's a 406-unit property. And it was built in the mid-'80s, but it doesn't have all of the physical and functional obsolescences you might find in some older properties. It has good bones, great amenities set, and we've been able to execute a value-add plan that has increased the attractiveness to renters, great amenities, and great floor plans. That's an example of a mid-1980s project where, again, we're pushing it to make it basically be the best B-class apartment community in the market and allows us to compete with newer properties since we have a multi-$100 spread between the Class A assets and where our properties are. We've had a lot of success with this strategy, and I think we'll find some unique opportunities in the future as many owners are no longer looking at 80s vintage assets, mostly focused on 2000s and newer. We love 2000s newer assets as well, more of a core plus strategy, but we think that some of the early to mid 2000s properties, kind of up to 2014, 2016, they're in need of their first round of value add improvements. Now, this doesn't necessarily mean going in and spending tens of thousands of dollars per unit, but often we're finding tactical opportunities to increase the amenity set, to improve the overall curb appeal, and to find smaller, lighter interior unit improvements that can still move the needle from $50 to $150 of rental premium per month without requiring to bring on significant amount of CapEx dollars, which can drag down returns. But there will also be opportunities for brand new properties that have been delivered in the last year or several years from developers that are somewhat stressed. These opportunities will look like us buying these properties at below replacement costs in an environment where it will certainly be more expensive to build these multifamily properties in the future. Tariffs are not going to make construction any cheaper, and general inflation is not going to make the labor to build these properties any cheaper as well. So being able to buy a property anywhere from 5 to 25% below its replacement cost, and it's brand new, being the nicest in the market, there's a clear advantage there as well. But of course, the cash flow has to be sufficient for us to make that allocation. But that entire quality spectrum, we think, is a great opportunity as renters who may have been renters by choice. They had the option several years ago maybe to acquire a single family home, no longer have that luxury, but they're still looking for a nice place to live, and maybe they're a young family, again, looking for a little bit more space, maybe an attached garage, maybe even a private yard that we feature at some of our properties. We have a key insight into what our renters and our demographics are really looking for. We go well beyond spreadsheets, well beyond returns, and we try to create environments and places where people want to be, want to live, and as we say, around the office, really pass the vibe check. Again, going beyond just the blocking and tackling of property management, we do a great job at that, but bring it to the next level of making residents feel like, they belong, that they want to stay. Because frankly, property management, the quality of property management over the last several years, especially since COVID, has been degraded. And I'm getting on a soapbox here now, bragging about our team at Gray Residential, but we have some of the best people in property management. We've leaned into technology. We're a relatively progressive company in that regards, but also it has to be backed with top tier customer service. Because the perception of residents, not that it's even always the case, but the rents have increased materially and the quality and service has declined, making residents frustrated because the bar is so low. And so what we have told our entire property management teams is ignore the bar because it's on the floor. We're raising it. We're setting our own standards of service we deliver to our residents. Now, we're not spending more money. It's not more expensive to do that. It just has to be intentional, leveraging technology and setting out to do things the right way. Operators that have had success for decades have gotten in a rut of doing property management the way that it's been done, again, for the last several decades. But post-pandemic, you have to operate differently. That's why we've gone to a centralized management platform. We've built a great portfolio specialist team that's right in between our regional managers and the property managers that can be quickly deployed to sites, but prioritizing what in-person interactions need to take place on site and what administrative functions are more efficient to do off-site, leaving more time for our on-site teams to interact with current residents, and they don't have to deal with accounts receivable or bookkeeping to keep the property running. In terms of some governance and oversight for the fund, I'm kind of returning back to the structure. We have an investment committee made of internal Gray Capital members, as well as an advisory board with outside members, longstanding Gray Capital partners, institutional partners that will be providing some compliance oversight to the fund. We use Somerset CBIZ for our tax and audit services, and Ice Miller is the primary legal counsel for the fund. All right, we've mentioned some of the markets that we are targeting, but let's go into a little bit more detail. We can take a look at this map right here, looking at some of the markets in Indiana that we like: Indiana, South Bend, Bloomington, Lafayette, Jeffersonville, which is right outside of Louisville, and Fort Wayne. In Ohio, we're going to be targeting Columbus as our main node, with Cincinnati and Dayton as secondary cities that we really like. In Michigan, Lansing, we already have a presence just outside of Lansing, but also the markets of Grand Rapids, Kalamazoo, and Ann Arbor, showing great growth prospects and very strong fundamentals. In Kentucky, Louisville, Bowling Green, and Lexington are all on our target list, and all of these markets are well within our operational capacity, and we've been spending years building the relationships with owners and brokers in all of these markets to build, I think, the most robust multifamily pipeline in the Midwest, of any Midwest firm. We have full, if you go into the deal room for the fund, we have complete market breakdowns. We have our own research reports for all of our target markets, and I highly recommend you take a look at those because we've really kind of gone deep into future job growth, the quantity and quality of those jobs, and spent a lot of time forecasting, looking at supply and previous rent growth, forecasting rent going into the future, which makes us very bullish on our primary target nodes of Indianapolis and Columbus. When I say target nodes, I'm speaking that way because those are our management nodes of where we will have dedicated personnel that we can deploy those into some of those secondary markets that connect to those nodes. Indianapolis is our current node in Indiana, and we will be establishing the second node in Columbus. Why Gray Capital? How are we positioned to take advantage of this opportunity? And we have the operational capacity, the track record to do so. Well, we have well over 60 employees to date. We've done well over $2 billion of commercial real estate transactions. In our portfolio, we have over 7,500 multifamily units. We're currently managing around 2,500 of those, with 16 active multifamily projects in our portfolio, and gone full cycle on 11 different multifamily projects, all profitable, delivering an average internal rate of return of 29.3% and an average equity multiple of over 2%. We're driven by data, having a dedicated research team. You may have seen our weekly podcast that covers the multifamily market and the macroeconomy, as well as our biweekly newsletter that does the same. And as I mentioned this before, again, we've never lost an investor dollar. We've never had to issue an unplanned capital call. And going back through this interest rate volatility we've seen over the last several years, I've seen many other market participants say, we could have never anticipated inflation and higher interest rates. Well, at Gray Capital, we were paying attention to the market. We knew what that type of spending, low interest rates would cause. We knew inflation was coming. We took those steps and shifted from we had been using bridge debt years prior and up until 2020. But then we made a shift, seeing clearly that inflation would be coming and interest rate hikes would be following. Our strategy shift to focus on fixed rate financing. We were somewhat ridiculed by peers in the market for not taking advantage of easy exits by buying with floating rate debt, flipping out in 2 or 3 years. At our core, we know that that's not how wealth is created over a long period of time. We're not market timers. We are just looking at the fundamentals and investing into assets that we believe have an incredibly high chance of success. Again, we are not in the business of taking ringers and hitting one out of several. We want all of our projects to be successful. It is the passion of myself and my team to do good work, quality projects, something that we can stand behind and we can deliver, again, to all of our stakeholders, which are our investors, our team, and our residents. If we can deliver for all three, we'll all see collective success. Just taking a quick look at some of our past projects, Villas on Fur is a great example of a newer property. It was almost brand new when we purchased it, but we were able to find so much operational efficiencies, take advantage of the time in the market. This was acquired in 2020. This project has been cash flowing well into the double digits for multiple years now. The last distribution was a 17.5% cash on cash return. Now, leverage helped in this deal. Low interest rates. We locked a 2.7% interest rate back in 2021. So a lot of the timing of this deal was very favorable. But we were able to drive these returns again, not just through the debt, but through again just operational improvements, bring marketing costs, admin costs down in line, and just then taking advantage of the growth in the market. But truly, all this was possible because we saw an opportunity in times of uncertainty. Again, we acquired this project in the middle of 2020. No one wanted to drive up to outside of South Bend to tour this property. We've looked at the data, we saw the demographics, and through balanced underwriting and accurate underwriting, we pursued it. And we're glad we did. Club Meridian, a similar story. Acquired this property in 2022. We're hearing a lot of properties of 22 vintage that are struggling right now. Capital calls, suspending distributions. We've never had to suspend distributions on either of these properties. And Club Meridian has continued to perform. Certainly, there's been some market volatility. We've addressed expense increases because just everything is more expensive today in 2025 compared to 2022. But we've been delivering cash-on-cash return of up to 7%, and it's been a great property to own outside of Michigan. One of the reasons why I want to continue to add to our portfolio outside of Lansing. You can view our entire track record in the data room or on the deck. As you see, we've exited 11 properties to date and still have 16 active properties throughout Indiana and the Midwest. Next steps. If you'd like to learn more about the Gray Capital's Midwest Multifamily Fund, get in touch with us. Reach out to Blake or Griffin. Their email addresses are right here. But also make sure that you've downloaded the deck. If you haven't seen the deck, you can go to graycapitalllc.com/Midwest, fill out a form. You'll be sent that deck. And then the best way, though, is to go get access to the Gray Capital investment portal where you can find our entire data room and deal room. This has the deck, operating agreement, PPM, research reports, white papers, additional material, due diligence materials on Gray Capital. This is an institutional offering with a $1 million minimum intended for family offices, registered investment advisors, and other institutions. While the fund is open for ultra-high net worth individuals, I invite everyone to start their due diligence process by getting access to that data room at graycapitalllc.com. Download the deck, get the PPM, start your due diligence process, and then make sure you schedule a meeting with a member of our investor relations team, whether that's Blake, Griffin, or myself. This concludes the presentation for the Midwest Multifamily Fund, sponsored by Gray Capital. Thank you for watching and looking forward to talking to you soon.